Hi guys, welcome back to my channel, Sharehost Talks Investing. In today's video, I'm going to be explaining what is a SIP. But before I do, can I kindly ask for you to hit that like button and please subscribe so you're alerted anytime I release a new video, which will be on a weekly basis. And one last thing worth mentioning is, if you're currently looking to invest, there's a great app in my description below called Trading212. When you download the app and use the promo code included and deposit just a single pound, both you and myself will receive a free share worth up to £100. So yeah, if you're looking to invest, it's a great app to use and definitely give it a go. So what is a SIP? So the SIP stands for a share incentive plan and is a tax advantage all employee plan that offers companies the ability to award equity to employees flexibly. So the shares awarded under a SIP are usually held in a trust, and provided they are held for at least 5 years, the SIP can be tax efficient for both the employer and the employees. Now there are a number of ways in which the SIP can be operated, and the employer can mix and match these modules from year to year, and I'll actually describe that next, what are the different ways a SIP can be operated. So the main features of a SIP are, SIPs can enable employees to get shares in their employer either free or from gross pay on a discounted basis. The shares must be held in a trust, set up and operate for the plan for a minimum of 3 years and up to 5 years to obtain the full tax advantages. And again, I'll go into more detail later on. And SIPs have a number of different elements which I will discuss next. So as you can see from the pie chart, the four main elements that make up a SIP are partnership shares, dividend shares, matching shares, and free shares. And the pie chart represents what a typical person's SIP portfolio within the company can look like, depending on how the shares are distributed. So the first element that makes up a person's SIP shares are free shares. So an employee can receive free shares worth up to £3,600 each tax year. However, it is worth noting that the free shares must be awarded to all the employees on similar terms. This means that they can either all receive the same number of shares, or the allocation can be a reference to an objective criteria such as remuneration or length of service or performance. So as an example, say Jenny has worked in the company for 2 years and the employer offers a benefit that if the employers worked up to 2 years, they receive 100 free shares, which at the time of her achieving that 2 years length service is worth £10. So those 100 shares would be worth £1,000. And this then brings us on to the next point, which is that free shares can be forfeited if an employee ceases employment within 3 years from the date of purchase, except in the cases of certain good leavers. And then tax relief will be limited if the shares are withdrawn within 5 years. So using Jenny as an example again, she approaches her 3rd year within the company and she still has those 100 shares. However, she receives a job offer from another company and decides to leave. At that point, she can lose all those free shares she gained from the company. Again, I'll cover more about this and the tax implications later on. And the second element that makes up the SIP shares are partnership shares, and these are usually most common. So your employer can invite you to buy partnership shares via deduction from your salary pre-tax and pre-national insurance contribution. And this is advantageous because the company saves the employer's national insurance contributions on this amount. So employees can actually allow deductions up to £1,800, or if lower, 10% of the salary each year. This means that the maximum amount of partnership shares you can buy within the year are £1,800. So employees can use this partnership share scheme to buy shares on a monthly basis or at the end of an accumulation period. So if an accumulation period operates, employees buy the shares at the market value at the beginning or end of the period. And the third type of SIP share is matching shares. The matching shares are where a company offers you the ability to buy partnership shares. The company can also match this by offering you matching shares, and the maximum allowed within the UK is from a ratio of 2 free matching shares for each partnership share purchase. So matching shares must normally be held in the trust for at least 3 years and held for 5 to get the full tax relief. An important thing worth mentioning is that matching shares can actually be forfeited if an employee withdraws his partnership shares from the trust within 3 years from the date of purchase, except certain good leavers. So again, this is another great way to increase your share amount within the company. So for instance, if you're buying one partnership share worth £10 and you're also receiving 2 free matching shares, which would also be worth £10 each. Basically, you're getting £30 worth of shares for £10, which is really good. So you can imagine the advantages of being involved in a scheme such as like the SIP scheme. And the last type of SIP share is a dividend share. So a dividend share is basically dividends received on SIP shares, which can be reinvested into further shares with no limit on the value of dividends that may be reinvested. So again, like the previously mentioned shares, dividend shares must normally be held in the trust for at least 3 years to get full tax relief. So as an example, we'll use that same example of £10 a share. If your company has a dividend yield of say 5% and you have £5,000 worth of shares accumulated within the company, which are a mix of partnership shares, free shares, matching shares, then this means that from the 5% yield would give you approximately £50 worth of dividend shares. Now you do have a choice. Companies do allow you to actually reinvest that money, the dividend money, back into buying dividend shares, or you can receive it directly as, if you do receive it directly as money, then you do lose the tax benefits that you would otherwise receive if you just kept your dividend shares within your company's share scheme. And now let's talk about the employee tax position when you're buying partnership shares or receiving matching shares, dividend shares, free shares, etc. So anytime you're buying partnership shares, you're actually investing your pre-tax salary to buy partnership shares. So this means that no income tax or national insurance contribution is due where the shares are held in the trust for at least 5 years. Also, there is no charge if the shares are released sooner in the cases of certain good leavers. So next, if the employee releases the shares from the SIP trust on or after the 5-year maturity date and sells on the same day, then no capital gains tax are due. Now, the shares can be held in the SIP trust indefinitely, provided obviously the employment does not cease, and there should be no liability to capital gain tax while they actually remain in the trust. The capital gains tax is only due where the shares are withdrawn from the trust and a day passes, and then the capital gains tax due are the base cost of the shares market value on the date they were withdrawn. Now you might also be wondering, okay, what happens if I actually withdraw my shares within 3 years? So well, if that's the case, then income tax and national insurance contribution will be due on the market value of the shares on the date of withdrawal. So if you purchased those shares, I don't know, a year ago for £20, and now within a year the share price of the company has gone to £30 per share, you'll actually be paying income tax and national insurance contribution on £30 rather than £20 you purchased it at, or £10 or whatever. So let's take another look and see what happens if you withdraw your shares between 3 and 5 years. So if you withdraw your shares between 3 and 5 years, then income tax and national insurance contributions are payable on the lower of the market value of the share at the date of withdrawal and the salary used to buy the shares, and that's for partnership shares, or market value on acquisition or matching of free shares. So as you can see, really, if you're planning on staying within a particular company for a length of time and they do offer a share incentive plan, it's definitely worth considering, because as mentioned, there are numerous benefits such as receiving free shares, receiving matching shares, and then obviously you're buying partnership shares pre-tax, so pre-national insurance contribution and free of income tax. So there's definitely a lot of savings you can make. And I actually do buy shares within my company using the SIP scheme, and I'll actually discuss that in a later video because I'm finding it very advantageous, and I'd love to reveal my portfolio, my SIP portfolio, and show you exactly what I've earned and how much I've actually put in to receive what I have. So yeah, stay tuned for my next video, which will be released shortly. And again, if you like the channel, make sure to hit that subscribe button and like, and also click the notification bell so you're alerted anytime I release a new video.